Well, unless you were under a rock yesterday, the Federal Reserve came out and they basically said they're not going to change rates, but they gave us new predictions of what to expect in 2024 and 2025. So we're going to go over that here in a second, but we have some fantastic news. Well, maybe it's one of those things again, bad news is good news and good news is bad news. So let me take it over to Rick Santelli over at this CNBC, because wholesale prices just came in and they actually went down. This is the producer side of the equation when it comes to inflation. So Rick, could you take it away and tell us what in the heck's going on this morning so far? Take it away, buddy.
Rick Santelli is standing by at the CME. Rick?
Yes, initial jobless claims for the week of June 8th, 242,000. That's a big pop. 242,000. We're expecting 225,000 last.
225 was expected, 240 came in. Is this what the Federal Reserve wants? Because remember they said they want people to lose their jobs? Well, let's see what Rick has to say about it.
Look was 229,000, although that still may get revised. 242,000, that is the highest level, and I have to go in the Wayback Machine here. That's the highest level since August of 23, since the second week of August of 23. We popped above 1.8 million on continuing claims, 1,820,000, 1,820,000. That's the heaviest level, and I have to go back a long ways on this one. 1,820,000 takes us all the way to November of 21. Because we've had so many benchmark revisions, that is really a big jump. Now, let's look at the PPI data. Wholesale inflation for May, expected on the headline to be up 0.1, is down 0.2, down 0.2. But not time to celebrate yet. We are down 0.1 in March. We are down 0.3 in October of last year, to put some context there. But it is definitely in the right direction if you're looking for less inflation. If we look at ex-food and energy, unchanged, much lower than expectations. And in the rearview mirror, we were 0.5%. Zero is the lightest, and once again, it was minus 0.1 in March of this year. So it's a big improvement based on expectations, but to some extent, been there, done that. Now, ex-food, energy, and trade, well, that's unchanged as well. In the rearview mirror, 0.4 becomes 0.5. Unchanged on there, comps to.
When he says unchanged, he means it's zero now. Okay, it was up 0.5%. Now it's zero when he says unchanged. That's a big move. He kind of just fluffs through it saying unchanged. So it really wasn't, went from 0.5 to 0.5. It was unchanged. It was basically went from 0.5 to zero, meaning it didn't change there. So a little bit of clarification there.
Minus 0.1 in November of last year. Now let's look at the year-over-year numbers, shall we? And I think sometimes these are the most important. 2.2% year-over-year headline. We're expecting a number at 2.5%, but this does match the rearview mirror, which was 2.2. And 2.2, back to back, now 2.2 last month, just revised to up 2.3. So we have 2.3 last month, 2.2 this month. To kind of give it some context, 2.3 comp was April of last year, 2.7 was March of last year. Let's food and energy, take those out, 2.3% on a year-over-year basis, 2.4 last month, so 2.3, that drop is nice. We're at 2.1 in March of this year. And finally, ex-food, energy, and trade, this one went up. 3.2, last look was 3.1, now revised to 3.2. So back-to-back 3.2s, those are the highest levels since 3.4 in April of 23, almost a year, a little over a year.
So that's what he's given us. So let me put this in the context for you. The main information you need to take from this is right there here. Okay, on Thursday, we had initial jobless claims. This is where the Federal Reserve's really watching. They're like, we need more people losing their jobs. Well, they got it. Previous reading was 229. It came to 242. Now, here's the producer prices, what's happening with them, okay? So this is the inflation level with the producers. So the thought is, if producers' costs are coming down, they're going to be able to help us on the consumer side lower prices, that aka inflation. So the number previously was 0.5 increase, okay, in prices on the producer side. Now it's a negative 0.2. So if producers lenders pass on this savings to us, the consumer, that means the consumer inflation numbers are also going to continue to come down. So that's the context I want you guys to take out of this report. We go over to Yahoo Finance and it says U.S. producer prices unexpectedly fall. This is the headlines we have through here. Weekly claims rise to a 10-month high. So it's basically good news throughout here. Now, here's what I want to talk to you guys about. This thing. What is it? Okay, this is the dot plot. So when I came out at the beginning of the year and I'm like, okay, the Fed's going to cut rates, and then they end up not cutting rates and things, other things like that. People are going back to me and they're like, Dan, you're an idiot. You don't know what's going on. You know, all this other stuff. What I want to show you guys is what I normally explain to is what the Federal Reserve is telling us. I'm not making this stuff up. So how they project to us what they're going to do is they create what's called a dot plot. Okay, basically what it is the Federal Reserve, all the members of the Federal Reserve, when they meet 4 times a year, now they meet every 6 weeks, but 4 times a year they come out and they put a dot on this plot right through here. So let me give you the background of this. The dot plot says this. It gives us the year down through here, and then it gives us what the federal funds rate is, or what it's expected to be, okay? So each Fed member, they come in here and they put a dot on where they expect the federal funds rate to be, okay? So what's happened is there was a revision from the last one that they did in March to this one. Okay, so now what they're signaling, they're still signaling rate cuts and still 6 or 7 of them, but now it's pushed out from now to the end of next year. Okay, so let me go down through here. So what you have to put in context is right now the federal funds rate is 5.25 to 5.5. There's a spread there. So we go over to this side right through here, and that's where we'd be looking right through here. It's 5.25 to 5.5. We'd be right in this range through here. Okay, you go over here. Right now there's 3 Fed officials saying at the end of the year that's where we're going to be. There's this many Fed officials saying there's probably going to be a cut, okay, down to 5 to 5.25. And then there's this many members that are coming out saying, well, we'll probably be at 4.75 to 5. Okay, this is from the Fed. So when people say, oh, the Fed never come out and said, they're going to cut rates. Well, this is their projections. Okay, so now then you see what's going on in 2025. Now, I'm not really going to go out to this piece, but this is, again, what the Fed's telling us. So they're saying that by the end of 2025, we're going to be at between 4 and 4.25. So that's 1.25 less than where we are now. So if they change in increments of 0.25%, that means there's at least 5 cuts in the estimates from here to 2025, the end of 2025. So when it's going to happen, I don't know, but the projections are this is, again, from the Federal Reserve, what they're telling us. What the markets are doing right now, right through here, we want to look at the what's going on in the MBS market. We're refresh because this thing's going nuts today. Right now, we have on the MBS front a plus 21. It's a nice take because a lot of times what happens the next day after a nice little rally is you get give back. Think of the stock market. If the stock market goes up 700-800 points, usually the next day it kind of takes a nosedive. Well, we're actually building on those lower rates right now on this. So we might see a reduction in rates of about 0.06, 0.07. So where are rates right now? There's where the rates are. These are the top 6 products people use when they're buying their first house. Not my rates. This is basically an average rate that Mortgage News Daily, they survey lenders all over the country. So we are in the 6% range now, finally on the 30-year fixed. I think it's going to go down just a little bit more. We might actually see 6.9 by the end of the day. So that's my report for right now. Come back later this afternoon. I'll give you an update of what's going on kind of midday to the closing part of the day to see if these rallies are continuing and what actually is going on with mortgage rates. But I hate to say it at the end of this video, but that housing crash that everybody's predicting, it never came about, and it should be officially canceled at this point because later this afternoon, I'll explain the supply and demand, how just a lot of people don't understand how that works. So my name is Dan Frio. I'm a licensed mortgage loan officer throughout the entire country. I'm licensed in all 50 states as well as Puerto Rico. So if you're out there and you're trying to say, okay, can I qualify for my first house, maybe my second house, an investment property, or it might be time to refinance. So if you closed in, maybe last October, November, and your rate was 8, you might be able to get into the 6s right now. So you might even look at refinancing. But if you're out there trying to buy your first house, the first thing I want you to do is hit the grant finder right there. It's going to search grants up to $7,500 to see if you qualify. And the nice thing about these grants, they're forgivable, meaning you don't have to pay them back. There's no lien on your property. There's basically no repercussions. I won't say it's free money, but it's the closest thing to free money you're going to get. So that's that. But if you want to kick the tires and see if you could qualify to buy a house in this market, I encourage you to click the Apply Now button right there, or scroll down to the bottom of our website and you're going to see this right here. That's our 800 number. That's our 800 number. You can reach us there, or you can email me directly at dan@therateupdate.com. Thanks so much for watching, guys. God bless. And all I ask you to do is, if you haven't done this yet, please do so. Please, if you haven't subscribed yet, please do that right down over there. Thank you so much. God bless. And I'll see you later this afternoon on the closing bell. Have a great day. Bye-bye.